Hello everyone. Today I would like to discuss an important topic in corporate governance, namely fraud. Fraud is one of the biggest challenges faced by organizations around the world. It can cause financial losses, damage a company's reputation, reduce investor confidence, and even lead to legal consequences. Therefore, understanding fraud and how it can be prevented is essential for achieving effective corporate governance. In this presentation, I will explain the definition of fraud, its types, causes, impacts, and the role of corporate governance in preventing fraud. What is fraud? Fraud refers to any intentional act of deception carried out to gain personal benefit or cause harm to another party. In a business environment, fraud occurs when an individual deliberately manipulates information, misuses company assets, or abuses their authority for personal gain. Unlike human error, fraud is committed intentionally and usually involves dishonesty, concealment, or violation of trust. According to the Association of Certified Fraud Examiners (ACFE), fraud is the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the organization's resources or assets. Types of fraud. There are three major categories of fraud commonly found in organizations. 1. Asset misappropriation. This is the most common type of fraud and involves the theft or misuse of company assets. Examples include stealing cash from the company, using company equipment for personal purposes, creating fake expense claims, manipulating inventory records and stealing products. Although individual losses may be relatively small, frequent occurrences can result in significant financial damage. 2. Corruption. Corruption occurs when employees abuse their position for personal benefit. Examples include accepting bribes from suppliers, giving contracts to family members or friends without proper procedures, conflicts of interest in business decisions, receiving illegal commissions from vendors. Corruption reduces fairness and transparency within an organization. 3. Financial statement fraud. This type of fraud involves intentionally manipulating financial reports to mislead investors, creditors, or stakeholders. Examples include overstating revenues, hiding expenses, manipulating profits, falsifying accounting records. Although less common, financial statement fraud often causes the largest financial losses and severely damages public trust. Impact of fraud on organizations. Fraud can have serious consequences for organizations. First, it causes financial losses that directly affect profitability and business sustainability. Second, it damages the company's reputation. Once stakeholders lose trust, it can be difficult to regain credibility. Third, fraud can lead to legal penalties, fines, and regulatory sanctions. Fourth, it negatively affects employee morale because honest employees may feel unfairly treated when fraudulent behavior is not addressed. In severe cases, fraud can even lead to bankruptcy and business failure. The role of corporate governance in preventing fraud. Corporate governance plays a critical role in reducing the risk of fraud. 1. Strong internal controls. Organizations must establish effective internal control systems to monitor financial transactions and business activities. Examples include segregation of duties, authorization procedures, regular audits, monitoring systems. 2. Ethical corporate culture. Management should promote honesty, integrity, and accountability throughout the organization. Employees should clearly understand that unethical behavior will not be tolerated. 3. Internal audit function. Internal auditors help identify weaknesses in controls, evaluate risks, and detect signs of fraud before they become major problems. 4. Transparency and accountability. Companies should provide accurate and transparent information to stakeholders. Transparent reporting reduces opportunities for manipulation and misconduct. 5. Whistleblowing system. Organizations should provide secure channels for employees to report suspicious activities without fear of retaliation. One famous example of fraud is the collapse of Enron in the United States. Company executives manipulated financial statements to make the company appear more profitable than it actually was. When the fraud was discovered, Enron went bankrupt, thousands of employees lost their jobs, and investors lost billions of dollars. This case demonstrates the importance of strong corporate governance, transparency, and effective auditing systems in preventing fraud. In conclusion, fraud is an intentional act of deception that can cause significant financial and reputational damage to organizations. The three main types of fraud are asset misappropriation, corruption, and financial statement fraud. Fraud often occurs due to pressure, opportunity, and rationalization, as explained by the fraud triangle. To prevent fraud, organizations must implement strong corporate governance practices, including effective internal controls, ethical leadership, internal auditing, transparency, and whistleblowing mechanisms. Thank you for your attention.